Well, hello everybody. I'm back in the saddle over here. How bad can this recession get? How's the stock market going to react? Let me just tell you this. We got some data on this extended holiday break, and it is looking more and more clear that we are headed into a recession. And on my last video of the Stock Market Brief Show, I laid out multiple charts also showing you various data points that we're headed towards a recession. And many people don't quite get it when I say recession. People think that that is bearish, but it doesn't necessarily mean that in the overall markets. Can it mean that? Yes. And today we're going to talk about how bad potentially it could get, but more importantly, it's all about preparing for if something does happen, an event, something unlikely, something that we don't know about, but we're all going to become professionals about it the soon as it happens. And, then we're going to post about it on Twitter, because that's what people do. All right, so what took place while I was away? Well, Monday, July 3rd, we had the ISM manufacturing PMI data. And then Wednesday, which is today, we had FOMC minutes, and we get more data tomorrow. Whew, get JOLTS, ISM services, and then even on Friday, we get jobs data. Now, the ISM manufacturing PMI is quite interesting. Why? Well, it came in at 46, which is under 50, which means it's contracting. But if you look at all the various components, shadoom, in the manufacturing at a glance, or the purchasing managers index, the manufacturing PMI, they're all under 50. They're all contracting. And Eric posted this really cool chart here showing that the percent of ISM components below 50, you'll see that it's very rare that you get 100% of the components, i.e. right over here, that are below 50. The last times that we've seen that happen was the Great Financial Crisis and the dot-com explosion. And if you take a look at the PMI, you can see that we're at a news cycle low, well below 50. And this has been really tracking well with the copper to gold ratio. If we're looking at a 10-year chart, we talk about these humps over here and how we started to see the rate of this kind of turn down. And that led us to believe that we'll see, we're talking about a way up in here before it started moving down below 50, that it looks like that we'll be moving into a contractionary phase, potentially entering into a recession. Now, this is a ratio line, so when it goes up, it means copper, Dr. Copper, is outperforming gold, and gold is more known as a safe haven. So now when it goes down, it means a safe haven, boom, is outperforming copper, and this is on a weekly time frame. And you can see copper on a daily chart. It had about 6 or 7 days of straight selling, and then we saw this reflexive bounce, which we were prepared for if you watched this show, and then we started to see a little bit more sell side today. And copper has been a really good leading indicator for the S&P 500. And what do I mean by that? Well, take a look over here at the October bottom. Well, while S&P 500 hit a new low in October, copper was actually building higher lows, creating a positive divergence. Now, this also works on the flip side. We talked about the negative divergences that are forming here, and we saw a little bit of a pullback. We have another negative divergence that's currently forming as it stands. Meanwhile, if you take a look at gold, we're contracting very tightly right now. We moved through a period of expansion, and now price is contracting. So if we start getting back above that 1950 level, this might be a trade that you don't really want to miss out on, because we could potentially come swing back up into this area, especially if we get back up through that 2000 range. The last time that we really started mapping out a trade here was the period where this was tight contraction was taking place. And we said that if it breaks down, look into this green zone over here for potential play to the upside. And sure enough, we hit that on the head and it started moving up higher. If you don't believe me, just go back and look at those episodes during whenever that time was. It looks like it was early February. One thing to watch, to pay close attention to, is obviously the dollar. The dollar saw a little bit of a move higher today. And that's going to be interesting to see how that correlates with gold throughout time, and even the S&P 500. As we know, when the dollar falls down, the S&P 500 has been going up, that negative correlation that we've been watching. And the same thing with gold, right? Dollar goes up, gold can go down. And typically, most of the time, we're at a negative correlation. However, there are periods in time that gold performs with a positive correlation to the dollar, and you can see that on the longer time frames pointing outside. So 180-day correlation between those two assets, 120-day. You can see it's starting to turn up here, and then even on the 30-day, you're starting to see somewhat of a positive correlation over here, and these ones on the longer time frame are starting to tick up slightly there, meaning that, hey, even if gold potentially starts, moving higher, the dollar starts moving higher, potentially gold might go with it. But we will see. We will see. The 10-year yield started breaking out of this consolidation pattern. It looks like it has a clear shot to 4% or 40 on looking at the TNX, which is absolutely mind-boggling over here. And, well, if you take a look at this chart that we previously discussed, when we get into these low levels with the PMI, this is where you typically move into a recessionary time, right? So all the components as we previously discussed, and then you start to look just to the left of the screen and you can see these are the periods of times when the PMI also reached down to these lower levels, which is more recessionary, and the recession portions are shaded there in gray. Alrighty dighty, but why is this time different? Well, it doesn't take a genius to figure this one out. Look at the CPI. The Fed is on a rate increasing cycle, right? So we're moving rates up to fight inflation to get down to their target goal of 2%. They're also tightening monetary policy. And if you take a look at this chart, right, 2000, that was the dot-com where we contracted, now we're contracting again. The difference is if you take a look at core and you take a look where that inflation was during these times, well, it wasn't up here north of 6%, which is crazy because this to me means more obviously stagflation. And if you take a look at inflation year over year percent change, this is a nowcast by the Fed. I think it's the Cleveland Fed. It's starting to price in July an increase in CPI. You can see 322 to 361, 511 to 522, and then core PCE 435 to 465. This was just updated today. So it's looking like we might be seeing an uptick potentially in inflation. And what does that mean for the Fed? Well, it means that they're going to potentially stick to their rate hiking cycle. Another 25 basis points looks like it's being priced in here in July. That's the July meeting. Even in September, it looks like we're pricing in the probability of another 25 basis point hike. And you can see here the probability of a recession, which we discussed on the prior video, is now still at around 70%. So the Fed is saying it, the data is showing it. What does that mean for the overall markets? Well, we need to be very tactical in this environment because, once again, you do not want to get caught off guard. Another thing is just the 2-year, 10-year curve and the 10-year, 3-month curve, right? These are highly inverted. We started to see a move slightly up today as the 10-year yield spiked higher, and we know that, hey, during this time where we got inverted on the 10-year, 2-year, when the curve goes deeper into inversion, we actually saw the SPY move up. And then deeper into inversion, we saw the SPY move up. Deeper into inversion, we saw SPY move up. Deeper into inversion, we saw the SPY move up. So if this starts moving up to uninversion, does that mean that we're going to potentially see the SPY pull down? Well, actually is what we've seen in prior recessions and prior crises like 2001, like also in the great financial crisis in 2008, 9, and so forth. Now, if we take a look over here, this is all measuring up to what we've been talking about. We have the top performing sectors on a relative basis, technology, communication services, discretionary. Year to date, those are our top sectors. Then it's moving into industrials. That's trying to find the stock market bottom. But the thing is with this sine curve is we haven't even gone into a recession yet. All right, it's seemingly likely that we're about there. And what does that mean for the stock market? It's going to be hard to say because we could very well get some sort of an event that we can't foreshadow, that we don't know. But I will tell you, it's going to look very obvious after something happens, right? It's always obvious after the fact. So it's best to prepare your household for something to potentially come. And I always say it doesn't mean short the market, doesn't mean sell all your assets. But what it means is make sure you just don't have racked up consumer debt or your leverage to the moon, and that you have an emergency savings and even an opportunity fund, because a lot of opportunities come, from recessions if you are prepared, i.e. the great financial crisis. When that took place, if you had cash, you could have got into real estate in 2010, 2011 and got some screaming deals. Okay, if we take a look here at the business cycle itself, if we haven't technically moved into contractionary phase yet, in the business cycle, moved into the recession, I showed you many charts, right, that were already going into contraction. What hasn't even played a role yet is bonds. So if these start waking up, it could be also a very good trade to watch in the near future. Now, I want to point out something that doesn't happen frequently. Now, these are this is my zone document. It's taking a indicator, and it's extracting bulk data from that indicator to give us potential upside, potential downside, and it gives us an idea of overbought and oversold in various markets and various sectors that I share on a pretty big file there in this section of my Discord. And if you want to join that, it's only $9 a month, or you can just pay a year. It's $90. You get an entire year. I put out some trade ideas there. I don't do alerts. This is not an alert service by any means. I'll make some announcements here and there during the trading day if I'm around my computer. I give my watch list. I give quarterly, monthly expected moves, weekly expected moves, daily expected moves, and a list of indicators as well. And then you get access to the community, all for basically one trip to Starbucks per month. Okay, and that's no joke, because I do work out of a Starbucks every once in a while, and I can get one coffee and a sandwich, and that thing's like $11. I don't get it. It's crazy. Okay, back to the zones. One thing that I called out that I want to pointed out to the Discord group, I want to just point out here too as well, but the SPX is reaching up to its higher part of the range, which means what's on these bands, there's a high point, there's a low point, and they're dynamic, they change, and then there's a midpoint. Well, when the S&P 500 is lighting up red in the range, it's telling us what? It means that the upside is 0.72% to the upper band, right? Boom. But then there's 2.62% downside to the lower band, which means price is right around here within this range, okay? So what I find interesting here, what I'm trying to get at, is that the dollar is also north of its range too. So something's not adding up. That correlation has not been holding for a long period of time. And I wanted to point out that there's been only two other times this year that we've seen that. That was May 18th and February 3rd, okay? Judging by the thumbnail that you saw with all the little arrows pointing to it, now we're getting into that. Okay, so you can see here on May 18th, we had bigger downside versus upside, and the range was red. Okay, and then the dollar, the range was red, and then February, right, S&P 500, boom, was red, and then the dollar was red. Now they had higher readings, meaning that they were a little bit more frothier than what we're currently seeing, but I still thought it'd be important to point it out. Now, where does that lie on the chart? Well, it lied on this day, and it lied on this day. And as you can see, this was actually a period where what? Well, it started to revert back down. And then even right here, market started to pull back down here too as well. Does this mean that it's a for sure thing that it's going to pull down? No, not at all. But the correlation as it stands from an intermarket standpoint that we previously discussed, that if the dollar is going to actually hold up at these levels or start to break out here, that could put pressure on the S&P 500. But if it starts breaking down, boom, maybe the S&P 500 has more gas in the tank to reach up to that 4,500 level or potentially higher. So that'd be what I'd want to pay attention to in the near future. Now, I didn't get a chance to post my weekly expected moves because of the holiday weekend. So this is the weekly expected move sheet that I share every week with my Discord group. So I'm going to go ahead and share it. You can screenshot this if you want to see the upper and lower levels. I typically just share here the S&P 500 via the SPY and then the Qs as well. But then we have 2 sigma levels. So we have upper, lower, and then so forth. So I'm going to share that with you there. We take a look at the book map. I wanted to point out on ES, there is a pretty big level of liquidity right there at around 4,500, and that actually coincides with the daily expected move. So this level going into tomorrow could be one to watch if market wants to start pressing higher, is at 4,500 level. Now to the downside, lower expected move is 4,458. 4,458 is right over into this area, and you can see down here there's not much liquidity, but we did have some liquidity right in this area earlier in the trading session. So we'll see if that lights up later intraday. This is software. If you don't know what this is the software that I use to trade intraday to see the order book, to read the tape. I can't read level 2s, like the data, the market depth. I'm not fast enough. My eyes don't work that way. And what this does is it highlights it on the screen, and I can play breakouts of key levels or buy areas of support if price comes down, and then know where to put good stops. But this stuff is absolutely amazing. They do give my subscribers a discount on the annual plans. You can save more, but then they also hooked me up with a promo code if you guys want to use that to get 20% off, I think, the monthly service. And then it's not just this software. You also need to get the data, and then they explain that on their site. I also link it into the comments, okay? All right, let's continue on and look at the summation index. The summation index identified a potential change in trend as it stands, a few trading days ago, like a week ago, and then the market's kind of just pressed higher. It's kind of going sideways as it stands right now. You do have a subtle divergence both in the summation index as it's below zero, and then also the NASDAQ McClellan oscillator there too as well. So this is going to be interesting to watch. It identified a potential change in trend. Okay, it did the same thing over here, but what happened? Nothing. But then it flipped back over, and then it gave us that potential change in trend to the upside. So continue to watch this, because if this starts curling back over, maybe we just a big down day, bam, then we might have to wait for the next flip over, okay? But as it stands, it's starting to curl back up, so it'll be interesting to watch. The summation index for the New York Stock Exchange had a little bit of a fake out over here. We didn't quite get a bearish crossover or potential change in trend, and you can see there is somewhat of a divergence here on the NYSE McClellan oscillator, the traditional calculation over here. So this is going to be an interesting one there to watch as well if this starts curling back over and we do get a potential change in trend. A couple other indicators that I like to look at are the bullish percent index, and I like to apply an RSI to them. And you can see here we have a rising bullish percent index for consumer discretionary. Meanwhile, the RSI is showing us a negative divergence. You can even look at it from here to there. So that's going to be another interesting aspect to watch as these divergences are currently building, and we're getting some interesting signals here on various intermarket aspects. If you take a look at the technology sector, bullish percent index, we had this negative divergence we called out that was forming, and the market pulled back, and we're starting to see it bounce, but that divergence there is still currently holding at these levels, as we're pretty extended also on this BPINFO chart. Another one that I like to look at is growth versus value, and I like to look at the rate of change between the two. When it crosses this down through zero, we've seen the Qs see some weakness at points. So you can see we crossed down through zero here. We saw the weakness, boom. Okay, it crossed back up. We saw the strength, and now it kind of doodled here where we saw a little bit of movement up and then weakness. And then now we're sitting right there below the zero line as well. So we have not only a divergence there, divergence here on the rate of change, it's crossing down through zero. So it's giving me just vibes of like, be a little cautious, be a little bit more careful here with how you're positioned. And I mean, if you've managed to make this, like everybody on Twitter, right, managed to catch the very exact bottom, they took no losses here, they caught the exact bottom, and they're up 3,000%. It might be worth taking a little bit of profits at some point, or updating stop losses. Okay, if we take a look at the BP-SPX chart, this thing is screaming too as well. It's in overbought conditions, and it's about up to that 70 region there. And typically these things move from overbought to oversold, right? Oversold to overbought. Overbought to oversold, oversold to overbought. So there will be a time where this comes right back down below 30. And if we are going to remain in a bullish trend, that could be a potential good opportunity to start looking for long positions. However, when we apply the BPOEX, so if I look instead of the S&P 500, I look at the S&P 100, you can see that there's a high and a higher high, where there's a high and a lower high there. So that's telling me that the bigger market cap names are actually diverging right now on the bullish percent index. So that could be another one to watch. Now remember, these are just divergences that are building. They need confirmation, which we have not got yet. Another one, industrial sector. Okay, this one has a negative divergence, as industrials have been performing pretty well, seen a big move from this tight consolidation, and we press higher. If you take a look at the Dow Jones Industrial Average Bullish Percent Index, we also have a divergence actually dating back over here to April, and you can see matching highs over here, then lower highs in the RSI, as this one has been really just range bound, and it looks, honestly, I mean, it looks like it could be a potential great setup if it's coiling up really good and we're moving into a period. Hey, if the market doesn't want to fall despite being in a recession, industrials is one of those sectors that do typically well. And well, they're not doing good on a year-to-date basis. They're, slightly up, but could still be one to continue to watch. Let's hop into the S&P 500. So on the daily time frame, right, we pulled back into where this prior area we labeled out, boom, landed right there, and we found some support. I just want to call out that we have a divergence that's building, and these things, they don't really happen all too frequently on the daily time frames. So I just wanted to just point that out, right? This is the only one that we've seen since, I have to go back a little bit further, and I believe that it caught one at the top of the bull market But as you can see, we haven't got one of these where we get an overextended reading, and then a negative divergence for quite some time. If we take a look at the 15-minute time frame, we have the upper weekly expected move, lower weekly, and then the white lines are tomorrow's expected move. So if we start slipping, well, we could take a look here that we're still above a 5-day inclining moving average, which means what? It means it's bullish at this particular point. If it gets down beneath it and this starts turning back around, then we go back to flip bearish. We talked about that right over here, how we're like, okay, be more cautious, but if we get back above, that can be bullish. And well, price held, and then it started ripping higher. And either you were part of the move or you weren't, because since this gap up, we haven't had really any price movement whatsoever. Pay attention to the week to date, quarter to date, month to date, which is currently all the same anchored VWAP, and we're currently below that. So the new quarter, if you're bullish, you want to get above and you want to hold above the quarter to date, right? If it's below it, well, that's not a great thing for the quarter, okay? So we'll continue on and look at the NASDAQ 100. NASDAQ 100 is also moving into an area of resistance, prior resistance. We mapped that out and it acted as that, but we're still sitting around the yearly high. And then I have this zone drawn out where it acted as prior resistance. Once it was broken, it acted as support, and then boom, it acted as resistance again. So this zone up in here, if price wants to run, take a look at 380 as a potential target, as that's going to be in the next area that was once prior support. Now, it's been a while since we've been there, so it might not matter nearly as much, but that is still an important level. Now, I also want to call out here that you can see we have a divergence on the daily time frame. Okay, so the RSI is getting weaker, and then the strength closing at a little bit of a higher point. And the last time we had a negative divergence, which these ones are kind of rare on the daily time frames, bam, we had that right here, which was where? Well, we had a higher high. And what I find interesting is that was that big move up, right? That big burst up higher as the market was moving into the new year, right? So it was November. We saw this big, strong move. Everything is like, yeah, see, all the bears they're all just worrying about no reason. Nothing to worry about. But if you look at my videos back into this time, we were talking about sector rotation. And that sector rotation, what we were noticing was what? Energy was the top performing, and consumer staples, healthcare, utilities started performing well. And that was what? It means that the stock market was potentially finding a top. Okay, now where are we? Well, we're right over here doing, the opposite thing. Okay, so I just wanted to reiterate that, yes, we saw a big spike up. We had a negative divergence form. We saw a spike up. We have a negative divergence form. We're starting to see sectors as this move went higher. What sectors are the stronger ones, right? Consumer discretionary, and also technology, which is looking at the Qs, the big ripper this year. Now, if we look at the 15-minute time frame, we are sitting there on the month to date, week to date, quarter to date anchored VWAP. So you want to hold above those levels, and we're above a 5-day inclining moving average. You can see we got below it. It acted as resistance, came, boom, came again, bam. But then we finally got above it, and then it flips to neutral. Okay, and then it starts looking for potential setups, right? Expansion, contraction, boom. And if you were in it, you caught it. And then we kind of just went nowhere after that point. But we are above that 5-day moving average. So it'd be more bearish if we come down here, we close down there, or we have a 2 sigma move down here, and then 5-day moving average starts turning back over. But as it stands, it's still inclining. So you can look for bullish setups. And how I would look at this is like, okay, so if we're looking for bullish setups, potentially look for a move to the lower daily expected move. If we get down there, it gets a lot of fear. Perhaps we bounce from that level. Maybe we undercut it and then bounce back in through it. That could be a good intraday trade. And then also to pay attention to just really this. Oops, what had just happened? 50. Yep. No. What's going on? No. Okay, there we go. This level, which we pointed out, I think it was 366. Right around this level where we had price acted as resistance, and then it potentially can act as a level of support if price comes down into this range. Other than that, if we start taking out this high, start to look obviously for the upper daily expected move, or even potentially this high to swing up and come into it. And then if we can even hold even further, look at 375.83 for the upper weekly expected move for 2 more trading days left, and we haven't really moved anywhere yet. So it could get wild, and it could get wild fast on this jobs data on Friday, or potentially even the data that we have coming out tomorrow. But that's all I got for you on today's episode, everybody. Have a wonderful night, and I'll see you back here later.